Okay, great. I think we can begin. Thank you all so much for joining me today in this webinar. So in this webinar, we're going to basically talk about whether this is a good time to sell. And if you had watched our promo reels, I had also requested a lot of you to bring in your external portfolios. We can also do like a quick portfolio review of your external, holdings and see where we stand. Right. So we'll discuss uh, as we've crossed the half year mark. We will discuss if this is the right time to sell, right? We will go through all of the trending aspects in the markets and how people invest. And we will also tell you what M2W and how M2W will help you in this whole process. Right. So first, of course, we have to talk about a major buzz, right, in the markets right now, like the surge in NFOs. But this trend is not new, correct? NFOs typically get launched in phases where investor sentiment is high and the market is already delivering good returns and the performance is priced in. The aim of all of these NFOs is to basically capture that kind of euphoria, correct? To attract investor flows and leverage that sort of momentum. But the real question that all of us have to ask ourselves is, are these funds adding unique value to our portfolios? Or is it just chasing momentum? Because most often than not, we chase momentum, we chase performance, and end up selling it in less than maybe 6 months of holding it only because of the excitement with which we bought it, right? And many NFOs. So if you look at this list itself, there are about three sectoral NFOs. There's one broad-based small cap, there's one income plus arbitrage, and there's an active momentum fund. So many NFOs are sector-based or they are themed around recent performers, say AI or consumption or manufacturing, and now even ESG, right? And these themes might sound attractive on paper, but it often come up after the sector has run up. But we as a house are very contra, right? By the time the investors enter, most of the initial gains are already priced in. And a lot of data shows that returns from NFOs launched during peak optimism are often underwhelming in the years that follow. Basically, saying that it is launched during its peak where everybody has sort of that's the time where everybody is looking at it, right? And most of the performance is already gone. But this isn't to say that all NFOs are bad, right? But as investors, what we must do before we invest is we have to pause and assess. Is this fund going to offer something different from what I already own in my portfolio? Is the fund house experienced in this category? Does it match with my philosophy of investing or your advisor's philosophy or your advisor's company's philosophy of investing? How will this fit into my long-term asset allocation? If we don't ask ourselves these questions at this time, right, we end up investing without purpose, but with impulse, right? Which is why I've called this slide the NFO excitement. So the key takeaway from the slide being it's to treat NFOs with the same rigor we would apply to any existing fund, right? Let the excitement settle, evaluate all of the facts, and always remember that investing should be consistent and not driven by any flashy sort of launches. And as a house, we always sort of propagate contra investing, right? We look at certain parts of the market when nobody is looking at it, and we try to make the most of it and sort of exit when the rest of the market comes in. Right. Similarly, we have also seen a lot of excitement behind SMEs. Right. There was a recent news article which gave us, funnily enough, it gave us an option between whether we want 5,000% returns from SMEs or 75 or 71% scams that we want to be a part of. Right. So let's now move on to another very prominent trend, which is the rush towards SME IPOs. So we get to see that across brokerages and social media, We're seeing record subscriptions, massive listing gains, and sensational headlines about SMEs. But behind this frenzy, there's a major risk factor, right? SMEs, as we all know, it's small and medium enterprises. They are fundamentally different from largely listed companies, right? They operate with thinner margins, they have limited cash flows, and it depends on a very handful of clients. And their regulatory disclosures are also less robust. They usually carry higher promoter risk, but uh, because they lure you into quick returns, investors are pouring into SME IPOs even without understanding its risks, right? The key issue here being the lack of liquidity. Once listed, these stocks can sort of see sharp falls on even the slightest of a bad news because there aren't enough buyers. Unlike large cap names, you may not always find an appropriate exit. And we must also remember that a good listing is not equal to a good business. A company gaining 50% on listing might be overvalued if its fundamentals don't support that price, right? And in the long term, it's the sustainability of the business and corporate governance and cash flow and growth that matter, and not the listing day hype, which is what happens with SMEs. People run so much behind the excitement and the frenzy and the flashiness of SMEs and the quick returns that it can give you for just a very temporary period of time. They fail to look at their, they sort of lose vision of why they started investing and their sort of vision for long-term investing, their goal and the core purpose of why they are investing. So this half yearly mark is a good time for you to go back and review your portfolio. Some of you might already be with us on the system and we're constantly giving you communication. If you're not, you can always reach out to us for a portfolio review and we will help you and explain as to why we are giving such recommendations, right? So now what I will urge all of you to ask yourself is, are you just being sort of are you getting caught by short-term gains or are you aligning with your long-term fundamentals? This question also brings us to a very important and interesting slide on small caps. We all know that small caps are a very sought after sector for literally just the performance, right? And this slide clearly shows that 11 out of 19 years, small cap index has given drawdowns of less than 20%. But what we feel is that at the moment, small caps are very overvalued and are a sector, is a category that we don't want to participate in. But if we do find a good entry point, then why not? It's not a bad, necessarily a bad category, right? In fact, it can be healthy because when valuations get stretched and stop again. So what I'm trying to do here is the structure of the webinar has been built in such a way that we want to explain all of the current trends that are happening and why people are holding on to what they're still holding on to in their portfolios and whether this would be a good time to, sort of sell all of those positions. Right. So when valuations get stretched and investor expectations become unrealistic, the market corrects to bring that certain amount of sanity. So corrections also help active managers to deploy fresh capital at better valuations. So given how risky small caps are, although we don't actively advocate into investing in that, in most of our IREs, not most, all of our IREs, we are giving small caps to be a sell whether equity or mutual funds. And we feel like this is the right time for you to exit such positions because one market up and you can easily sell the next market up. So if you're worried about, the taxation part, you can sell it in tranches. right? First market up a certain percentage of it. Next market up the next percentage, right? Half yearly review, should you sell? So I'm building the conversation up in such a way that I want to give people an idea of what are the various trends that people are running behind, which is stopping them from sort of selling. In short, to answer the question whether this is the right time to sell all of those positions, definitely yes, because we're definitely seeing a very volatile scene in the market. One market up you can sell, the next market up again you can sell and come out of your existing holdings, and we can make it a better portfolio for you for sure. If you reach out to us, we will help you. Right. I will also. So this brings me to a very important slide on market cycles, right? And which is what is very key to whether people should buy or sell, or what the investor psychology is. So every investor psychology follows a very familiar cycle. When prices rise, we're told to buy more, and when prices fall, the same voice is yelled sell, right? This reactive behavior, most often than not, it leads to very poor outcomes. So let's just quickly break it down, right? During bull markets, media and peers, they sort of reinforce positive narratives. Valuations are justified with so many stories. When we buy during these times, we often buy expensive assets. Then comes the fall, right? The same voices, it starts to predict the fall. You exit in fear, you lock in losses. And this is the classic buy high, sell low kind of trap. So now think of an investor who did the opposite, right? You bought during the dips, stayed invested during corrections, and exited with a plan. And this investor likely saw a superior long-term outcome. Why? Primarily because they weren't reacting to the market noise and they were being guided by strategy. And this is the real outcome of fear. The real outcome of greed and fear is underperformance, and the real outcome of discipline is wealth creation. So you ask yourself if you're investing with emotion or with a framework, and what sort of an investor you are, whether you're capable of selling at the right time, because it's not about timing the market, right? A lot of you may be doing it on your own and you may be aware of the market cycles that are going on, but some of you may need help in terms of having an advisor by your side. So this cycle sort of takes us through a lot of emotions, right? So we know that the markets move in cycles. There are times of euphoria, it's followed by corrections and then consolidation, again recovery. So each phase brings different emotions and challenges, but all of the phases are necessary in an investor life cycle. So understanding these market cycles is what helps you become a better investor and helps you take that decision of whether you should sell, right? Right now, we're shifting from optimism to caution. We are seeing that large caps are consolidating. There is a lot of global headwinds like rate hikes, um, RBI rate cuts, geopolitical tensions, which is causing short-term jitters, etc. Right. So because of this, we are seeing a lot of market volatility, which is why we are also advocating people to invest in debt as a category to bring in some stability. Right. So those who exited during similar times of uncertainty miss the subsequent recovery. So the key is not to time the market, but to ride through all of these cycles with discipline, right? And this is where diversification helps you. And that's where M2W sort of comes in. Well, that's where I thought helps, and that's where M2W helps. So take this as an opportunity for you to review your portfolios, because we feel like this cycle of the market is not going to repeat itself for a while. You can either reach out to your advisor or you can send in your portfolios now here on this, either on this call or after the webinar. You can reach out to us on the number that I will put in the chat box, and we can review the portfolio and send it to you. No, sir, you're right. I'm sure that's why I mentioned that a lot of you are already on the system. And we constantly give you communication and keep reviewing this for you. There are other leads also, fresh leads also that are on the call, which this webinar might help them as well. But if you have any questions on how your portfolio is doing, you can definitely reach out to your relationship manager and we can take it forward from there. So what does iThought do, right? Our promise, we want to reiterate our promise here. Like, we're not here to impress with any sort of short-term returns, right? We're here to guide you with long-term conviction, and our investment philosophy is very centered on safety, suitability, and simplicity. We will handhold you, guide you, teach you, and just stay with you through the entire journey, right? We don't chase the latest theme or product. All our decisions are very research backed. We believe in researching very deeply and choosing selectively and allocating wisely. Right. So our focus is not just on returns, it's risk adjusted returns. And we want your portfolio to sort of grow with stability and not just speed, right? And we also want to help you avoid all of those small common mistakes, stay calm during volatility, and make informed decisions while also keeping you on the loop. And we will never you will never hear us tell you what is trending or what's the best thing to buy at the moment. We will always guide you based on what is right for your portfolio and what would be right for you as an investor. So this is where the M2W program comes in. We help all small investors reach their first crore by hand-holding them through each process and reviewing their portfolios, helping them exit positions at the right time, and be in those parts of the market that are doing well, and curate each and every client's portfolio to their needs and requirements and goals, right? It's a very guided journey. It helps you create wealth steadily over the long term using a framework that is goal-based and process-driven and periodically reviewed. So we start by understanding your current financial state, right? Your income, expenses, liabilities, and your risk appetite, most importantly. And we will define your wealth. We will define a wealth map for you. We will define your goals. It could be a retirement corpus. It could be children's education. It could be a dream home. It could be anything. And we will then build a plan with phased investments. It's either SIPs, lump sum, or a mix of both, and constantly rebalancing your portfolio. And what makes M2W different is that guidance, right? You're not navigating alone. You have an entire team that monitors the progress, adjusts for change, and keeps you on the loop. And this hand-holding ensures that you don't drift away during any of the market noise, right? So from your first crore, from your first lakh to your first crore and beyond, this is what we help you. We help you get those tangible outcomes. We have seen clients who started with very modest SIPs. They might have started with like 10K or 20K, and they've built very meaningful portfolios over 5 to 10 years, right? And the common thread was just consistency, not aggressiveness. And it's not just about the wealth, right? It's about building that confidence. Investors who follow a process are less anxious during corrections, and they don't sort of second guess every dip. They know that volatility is definitely part of the plan, and we help you during such volatility. Right. So from where you are to your 1 crore, if you just get a few things right, you will definitely be on track. You don't need to do everything perfectly right. We should just get the basics right. You start early, you save consistently, you insure yourself, very, very important. Be very tax efficient, diversify your savings across assets, manage all your loans well, and definitely plan for your future. That's the idea of investing, right? And these are a few good habits. If repeated over the years, it does more for your wealth than chasing all those hot tips or timing markets, right? And that's the core of M2W, helping you focus on the essentials. Because what happens is, in personal finance, we've heard a lot of people say, and Shyam sir says this always, that excellence lies in simplicity, right? The boring, consistent approach is the most rewarding one. And let's not complicate what is meant to be clear, right? And as a house, we are not passive advisors. We stay engaged. We are constantly speaking and sending out communication to all of our leads and clients. If the markets change, we realign. If your income changes, we adapt, right? And MTW is very flexible. We will tell you what the right time to sell is. This being a webinar for half yearly review, it's a good time for you to come out of all of those positions that are risky, which we feel are risky. You can feel free to send us your external portfolios on the number here. You can send us a hi on WhatsApp, or you can just straight send us the external portfolio, NSDL or CDSL statement, or any other statement that you may have. And let me tell you, you may not find a better time to exit such risky positions and deploy that money in other opportunities that are currently doing well. We are looking very bullish on large caps. Of course, large caps have always been a category that everybody falls back on. Apart from that, there's consumption. We're looking at debt for stability. There's banking. And we're also evaluating other parts of the market. But for now, our bullishness continues on this, along with the gold and silver as well. So this would be a right time for you to, again, I'm reiterating that this would be a right time for you to exit all of those risky positions in small and mid caps, and deploy the gains or those investments into other parts of the market, right? I will end the webinar here and open the floor for questions. You can feel free to put your questions in the chat box. You can write to us. The number is here. You can call us.